Well, good evening. Welcome to this live stream on the 10th of February 2026. It's Martin North here from Digital Finance Analytics. Great to have you on this evening. Thanks for taking time out of your Tuesday evening to spend with me. Really appreciate it. And the community, of course, is on the chat, and we're going to get some of those comments in as we go. I've got a load of questions that I received earlier, a record number of postcode requests, so we're going to try and cover those tonight. So that'll compress some of the other conversation points. But essentially, before I go any further, we'll remind you that we are providing general conversation only. This is not financial or legal advice. We moderate the chat, but feel free to throw questions, comments in. If you use that Walk the World DFA, that'll get into my queue and I'll see your question. I've enabled Super Chat, which means you can get your question to the top of the list, or indeed make your interest in what we do around here. Really appreciate all those who support us, whether it's via Super Chat or whether it's Patreon or PayPal. It makes a huge difference to us being able to make these shows. Thanks very much for your support. So today, it's very much about the questions of what's going on in the finance and property sector, and particularly looking at household finances. And I called this a deep dive into our household and property data because, yeah, we are going to go quite deep this evening. There are different ways of slicing and dicing the data, but this way, for me, gets to the heart of the matter. And I want to highlight, I think, three things. One is, it's not the same across the country. There are different places with quite different stories going on at the moment. Secondly, a lot of households are doing fine, but others are not. So let's look at some of those. And thirdly, the impact of government policy, and that's everything from the housing problem through to the way that the regulatory system works or doesn't work, and a few other things too. And some of the policy settings from generations or two ago are now flowing through. All of those things are actually in the mix here. So we're going to try and touch on some of those too. So we will get some of the policy issues. And effectively, what I want to do is to just start with a little bit of an overall view of the latest data that we've got from external sources. Secondly, I'll then quickly go through the latest results from my surveys and analysis. And then thirdly, go into the detailed postcodes that we got, combination of those that have actually been received already, and an opportunity if you want to add to the list as we go through. Smooth's already put one on the list there, so we'll try and get to that. No promises. I think if I cover them all, we'd probably be here until the middle of next week, which is probably not going to happen. So we'll see how we go. Anyway, I guess to start, let's just go here. So the latest consumer sentiment data from both ANZ and Roy Morgan ticked down. And this is the IFM summary of the data, which is a rather nice way of looking at it. They made the point that the financial situation is degrading for consumers on aggregate to average, that the economic conditions are also falling as well. Sum of economic condition and sub-indices, 12 months and 5 years. So it's an aggregate index, but it shows that not short-term only, but long-term too. Oh, and the inflation expectations has risen. So that's not good. And I'm seeing a lot of the storylines there. Cookie, I will say to you, yeah, nice to see you. Thanks for dropping in. Thanks for sending all the slides and things through the week. And have a nice evening. Get up for your 2:30 a.m. start. Oh, as Jason says, that's hurts, and that's an hour earlier than last week, said Perry New. Yes. It is, shockingly. Anyway, thank you for dropping in, and appreciate all your support to Cookie Boy. So let's just go on with the story here. Financial Review says that the bleakest ever outlook for economic activity is now in forecasting 1.6% growth over the year to June 2028. Now, let me just make a point about this, because the way that the RBA forecasts is they plug in the future expectation of interest rates. They make an assumption about productivity, I think 0.7% last time around. And then they turn the handle on their model, and that's what gets spat out. So it's not really a clean forecast. It is a forecast that's actually determined by what the market thinks rates are going to do. And as I've discussed before, rates, of course, are expected to rise from this point. The question is how much. The 2-year bond at the moment is at 4.259, which is actually quite high. Maybe I'll display that chart. Hang on, let's just turn this across here and go to there. Yeah, so this is the 2-year bond, Australian bond, and you can see it's at 4.259. And the 10-year is also up pretty high too. So you can see that the story is that rates, based on the market view, are going to go up. They're forecasting maybe another couple of rate rises from this point. Now, whether that's true or not, I guess we'll wait and see later. But the fact is that it is quite important to understand that the market input really drives the RBA analysis. And so you've got to question, does it make a lot of sense? And yes, they've got an inflation pressure issue, but there are consequences for the decisions. And as we'll see later, there's a lot of questions about different parts of the economy doing different things. That's one of the issues they've always got, of course, insofar that the trajectory ahead is not uniformly spread across the country. There are sectors, Western Australia is doing better than, say, Victoria. Now, in terms of other data points, this was quite an interesting one. This was the spending indicator data yesterday from the ABS, and it showed there was a small increase, 2.4%. But it is fascinating to look at it in more detail. And when you look at it in terms of the growth on population versus the growth on real spending, the bulk of the lift, as this slide shows, is based on population growth. So in other words, it's the high migration that's creating the momentum more than people spending more. And if you look carefully at the data, most of what people are spending is on necessities. There was a bit of flights and what have you over the summer with holidays, but a lot of it's necessities. And in fact, I note that the ABC published this one, which was a similar sort of slide. Alan Kohler spoke to it very recently, talking about the fact that the bulk of it, 1.8%, was actually population growth. Spending per capita was only up very slightly. So that's worth just bearing in mind when you look at this data. It's not quite what it seems to be. And now, in terms of the implications for housing and everything else, there's some really interesting conversations going on at the moment. And of course, we'll talk about the rate pressures and how that translates into mortgage stress and things shortly. But just to make this point, that the media releases from the HIA talked about the housing target very much under pressure, highly unlikely going to meet it. But they also were very keen to tune down. More tax on housing is not the answer to inflation. And that, of course, is back to the CGT conversation. The CGT discount is likely to cost $247 billion over the next decade. And so there is now a question as to whether the government will or won't do something about it. It's interesting that when you look at some of the charts here, this one here shows you that when the capital discount gains was introduced, guess what happened? We had this dispersion between dwelling prices and household disposable income. But let me make the point that there were other things going on at this point too. There were, for example, significant deregulation of the financial markets. There was increased competition between lenders. The lending multiples were changed. So to sheet all of the momentum here to just one policy change, the capital gains discount, is, I think, misleading, but it is one of them. And if you look at the proportion of lending to investors and for investment purposes, once those changes to both capital gains tax and the negative gearing, once they flowed through, it's allowed investors to shoot into the market much more strongly and help to drive prices high. But my point is, this is a multifactorial problem. It's to do with supply, it's to do with migration, it's to do with lending policy, it's to do with a bunch of other things. You can't just sheet it to one policy. And so the question is, of course, whether in fact, if they turned the dial on the capital gains tax discount, whether that would have a profound effect or not. I don't think it would. It would have a marginal effect. It would help the budget possibly. But to my mind, this is actually not getting to the root of the issue. Now, just talking about roots of the issue, well, of course, we had Bullock coming out and saying that part of this was to do with fiscal policy. The battle, of course, between what Chalmers is saying versus what Bullock is saying. Also, I think Christopher Joy the other day said that the RBA has no idea what it's doing right now. It's caught in the middle of a tug of war between preferences for its political masters and the policy constraints imposed by the hard data that cash its credibility. Yep. And certainly the banks passed on their rates very quickly pretty much within hours, everybody got the rate increases on the variable rates coming. And economists are saying that, well, that's not be enough to cut the inflation issue. It's more retrenched, probably need more rate rises. And the Mark Knight cartoon here, which I thought was wonderful, which was picking up Tarek's thought of the burnout economy. So you've got Chalmers stoking it with government spending, high levels of government spending, and then Bullock pulling the interest rate lever and asking why we're not slowing down. To me, it's a very important question. And, a lot of those settings are actually wrong. And it's interesting, Jason made a point, and I think that's worth thinking about. How does the CGT impact the crypto? Good question. Not sure yet. Too early to see. I'm not seeing a lot in my data on that, but I'll be watching out for that as we go forward. And hi there. Nice to see you dropping in. Thanks for joining us this evening. Now, if I take the conversation forward then, we can talk about obese government spending and all those things. We can talk about the auction hot data, which wasn't so hot. I made a show about that the other day. And I looked at the totality data and showed you that the real clearance rates were a lot lower than the ones, because, of course, they calculate only the clearance rates on those reported, not everything. And as I made a show recently, home prices are still bubbling high. It varies by location, but you can see here that, some places are really growing quite strongly still. Adelaide is leading the pack there at the moment. Brisbane, this is the prop track data. But it is varying, and it does vary across different locales. And you can see here that the locations and values are actually connected. So Sydney, the average on all dwellings, 1.23 million. Melbourne, 849,000. So they've dropped well below Brisbane, over 1,023,000. And Adelaide and Perth. And to think that property prices in Adelaide are now higher than Melbourne tells you something probably more about the mismanagement of the local economy in Melbourne than anything else. It's pretty shocking to see. So, we've got a lot of issues to deal with. The other thing I want to highlight just as we move into this next phase of the conversation is that CBA put out this housing affordability calculation and showed that the affordability was still pretty shot, and this was before the most recent rate rise. But I want to highlight this. It's really important to understand their definition of affordability is based on, quote, dual average full-time income household buying a medium-priced home. So this is 2 full incomes. Now, I can simply say, years ago, it used to be 1 and a bit incomes. So they've shifted the dial because, of course, more households now have to throw 2 incomes in to be able to actually afford to buy anything. And the fact they've normalized that in their affordability calculations and charts really worries me, because it just underscores this next point again, that if you look at capacity to pay relative to the median house price, it's just gone, it's departed. And that correlation was closer back in the 1980s and 1990s, but in the early 2000s, it fell apart, and it's then dramatically fallen apart more recently, particularly as incomes have been frozen in real terms. So that is part of the problem. And I've captured that, of course, in my core market model to sort of take the conversation forward. We run surveys, we put that information into the model, we analyze it, we slice and dice it, and we think about what may happen again in the future, looking at scenarios. We'll talk about scenarios shortly. And that means we can take our various elements from the model, bung it through the scenarios, and at a postcode level, region, state, or Australia level, we can form a view of what may happen. Now, a quick plug, please, just to say that if you're interested in a one-to-one conversation about a particular postcode, I can do that. This isn't financial advice, but it is actually a chance to look at the underlying data and trends and talk about what may happen. We can do it by Zoom or phone. It's about an hour conversation. There is a cost involved because, of course, I have to do the research, about a day's research all up to be able to put it together. So it is actually quite a lot of work, but you get quite good insights. You get a report. And if you are interested, you can contact me via the blog. The blog is there with a little contact button, and you can contact me there. And I'm booking 3 or 5 weeks ahead at the moment because of this fact there's so much in the way of demand for this service. A lot of people trying to work out what's going on, and that's reflected also in the number of requests for postcode data tonight, which we're going to cover very shortly. Just in terms of stress, remind you, of course, that there are many, many different definitions of mortgage stress, rental stress. I use a particular definition, cash flow. Some people talk about 30% of income. Some people talk about 30% of income gross or taxable. Others use underwriting metrics, but I use cash flow. And I look at households, money going in, money going out. If they've got a mortgage and have a deficit, they're in mortgage stress. If renting, rental stress. Look at it from an investor perspective too. Put it all together. We can look at total financial stress, and we can look at both in percentages of households and count terms. The latter is best because of the law of big numbers. And it's worth saying the RBA put this chart up some time ago, which I love, which shows that the spectrum of household financial stress moves from mild, the budget pressure end, via missing payments to insolvency. That journey can take 3 to 5 to 7 years quite often. I measure it at the mild end, so budget pressures. Are people actually struggling to get by? Some fall into missing payments. Some might go insolvent. Now, insolvency rates are very low at the moment. That's partly because the banks are still extending and pretending, asking people to sell if they have got pressure. So people are actually selling and getting out because prices are higher, which means the bank's safe, or indeed extending and pretending by way of offering mortgages longer or interest only, but it does create more pressure. Now, in my latest modelling, this is to the end of January, let me just talk about rental stress. So 75% of people in the rental sector under cash flow pressure. Mortgage stress is at half. About 50% of households with mortgages have cash flow pressures. You can see how both those have jumped up dramatically, particularly from the March to May 2016, 2017, 2018. COVID was also another catalyst, of course, all that government largesse and also ultra-low interest rates, all creating pressures. And then the debt-to-income ratio, according to the RBA, is coming down slightly, but that's really distorted because it includes all households, whether they've got mortgages or not. So you need to multiply it by at least 3 times to get a clear view. And in fact, the truth is that the debt-to-income ratio for new borrowers, quite a few of them are still 6, 7, 8 times, which is pretty extraordinary. Now, here is the data for January, looking at the stress data by state. I've highlighted in yellow where it's gone up from last month. And you can see there that half of those mortgage-stressed households are actually in difficulty. That's about 1.8 million households. Rental stress at 75.4 is 2.3 million households. Investor stress at 17.8% is about 528,000. Financial stress at 47.5 is, well, it's a horrible number, 4.756 million households out of just over the 10 million households that exist in Australia at the moment. And you can see there that it varies by state, but it also varies by category too. And there are some areas where it's gone up, some areas where it's gone down, but it's looking pretty shocking. And bearing in mind that we have had, of course, those rate cuts, you might have expected things to be a little bit easier. You might have expected with, quote, real rates of pay rising. But no, because of the cost of living still driving through, we've not seen any real relief in this level of stress now for quite some time. Households are sort of adjusting, so they're adapting, they're cutting out on spending, they're cutting back where they spend and also what they spend money on. And they also try and buy cheaper goods, for example. And in some cases, we've seen people cut back on medical expenses and not getting their teeth done and those sorts of things, or indeed pulling kids out of private schools. A lot of things that can be done to essentially be able to keep the wolf from the door. But the longer this goes on, the more difficult it's going to be to deal with it. If you look at it another way, this is actually the data by segment, and you can see there that it varies. I will just highlight that young-growing families are where a bulk of the issue is for mortgage stress. Rental stress is high across many cohorts, but particularly the multicultural establishment, which are the first-generation Australians, 83.9%. A lot of people coming into Australia as new migrants and getting into difficulty almost immediately. Now, the next data set is just beginning to show you the top postcodes. This is the mortgage stress one. So Liverpool, 2170, Campbelltown, 2560, Roxburgh Park in Victoria, 3064, Wanneroo in Western Australia, 6065, and Toowoomba in Queensland are the top postcodes with mortgage stress based on the counts of households. If you look at the risk of default, you can see that places like Cranbourne, and Mandurah in Western Australia, Armidale in Western Australia, Tarnit in Victoria, another Western Australian. But interesting, those Western Australian postcards at the top of the list there, because that was the previous problem. House prices went high, people borrowed big, prices dropped. They then were in negative equity or had difficulty. Prices have recovered to an extent, but quite a few people are still, from a cash flow perspective, under pressure. As well as now Cranbourne, one of those high growth areas, as is Derrimont and a few others there, Roxburgh Park in Victoria. High growth corridors, a lot of off the plan properties, a lot of high first time buyers. And then regional areas like Bundaberg are Toowoomba actually on the list too. If you look at rental stress, you can see there that Liverpool, centre of Melbourne, Toowoomba, Southport in Queensland, Cooma in Queensland, Westmeath in New South Wales, all very high levels of rental stress. And it's not getting any easier, unfortunately, in places like Parramatta and Ipswich and Bundaberg, Mount Druitt, you can see them on the list there. If we then look at stressed investors, Toowoomba, Cranbourne, St Kilda, Westmead in New South Wales, Bundaberg in Queensland, Southport in Queensland, Craignish in Queensland, and Hornsby in New South Wales are all where investors are having trouble. And that trouble is from two things. One is the costs of the investment property are rising because of higher maintenance costs, higher interest rate costs, higher management costs. There's also a limit to how far the rental can be lifted because, of course, rental is more connected to the income of potential renters rather than actually the price of the property. So net rental yields in particular are continuing to degrade. And so there are property investors, particularly in Melbourne, who are actually wanting to get out, but we're seeing it in other places too. So I'm fascinated by this dynamic where you've got on one hand a lot of people trying to buy into the property investment sector. The data we'll get tomorrow, I think, will show another very strong outturn for investor funding. But there are also investors looking to escape as well. So that's another little factor. And of course, the interesting question is when investors escape, who buys the property? Is another investor, or is it actually going to a first-time buyer? Well, there may be a mixture of both, but it doesn't necessarily solve the real problem here that rentals are still too high relative to income. The next one to look at briefly is just the financial stress. This is the aggregate data. So the postcode with the highest level of financial stress is Liverpool, 2170, with 29,000 households in financial stress, then Toowoomba up in Queensland, then Campbelltown in New South Wales, Roxburgh Park in Victoria, Derrimont in Victoria, Tarnit in Victoria, Cranbourne in Victoria, centre of Melbourne in Victoria. Now, all those Victorian postcodes, that is one of the reasons why the economic momentum in Victoria is so weak. It's really flowing through now from this. Ipswich, of course, is on the list there too. Ballarat, another regional town in Victoria, Mount Druitt, Belwood Park, Southport and Bundaberg. And I want to highlight those Queensland postcodes because, of course, everyone's saying Queensland's doing great. No, Queensland is not doing great necessarily. Some people in Queensland are, some people aren't. Now, in terms of my modelling, there's a lot of ways I could take this conversation forward. And I'm not going to show this on the stream tonight, but I do have data, mapping data, showing the footprint of mortgage stress, rental stress, financial stress, defaults, gross investment returns, net investment returns, and both the net wealth footprint and the gross debt footprint. If you're interested in seeing maps on any of those, I made them last month in my show there. Check that out. Drop a comment below and maybe I'll make a separate show looking particularly at the mapping, because what I want to get onto now is the specific analysis down at the postcode level and begin to ask some of those and answer some of those questions that I had in the chat. Now, to do that, let me just talk about the scenarios. These are not predictions. These are sensitivities. These are analyses of showing how things may change in different circumstances. I don't make predictions about the future. I just tell you about my scenarios. There are three. And in fact, to take you through those scenarios, there is the best case scenario where you've got rates sticking at 3.85%. Inflation stays above target, comes down a bit later. Migration remains above average. We get the boom in first-time buyer purchases. We don't get a recession, and we get strong wages growth compared with inflation. So that's one scenario. That's the best possible, I think. Then you've got a base case scenario where you've got a further rate rise in May. We got a stuck at 4.1%. Inflation eases later in line with RBA expectations. It's really in 2027, 2028. But wages rise slower than inflation. We get a recession, in fact, because of that low growth, etc., etc. Migration falls to average. And it's that fall in migration that leads to the recession, because the strong migration is preventing a recession in Australia at the moment. The third, the nightmare, is we've got the rate rises going up. We've got inflation still being strong, but we get a rise in unemployment. Unemployment, of course, is the key. If a lot of people are out of work, they can't pay their mortgages and rents, and therefore things go really bad quickly. At the moment, with unemployment relatively low, most people are managing to get by just. Wages growth stalls in this scenario. Rates are cut later. Migration drops well below average. We get stagflation, and that creates less demand for property. So those are the three scenarios we look at. And it is just sort of trying to show you some sensitivities in terms of the various angles of attack here. And of course, it translates into price momentum one way or the other. This is actually the average Australian output from my model. So you can see the best case scenario still shows further price growth is certainly possible. On aggregate, not massively strong, but up. On the other hand, if you have the base or the worst case scenarios, then you have falls over the next 2 or 3 years. Units will tend to follow on, fall a little less for two reasons. One is there's quite strong demand, and actually because prices are a little lower, it might be a little bit more resistant to price falls in the worst case scenario. So there you go. That is my sort of positioning to be able to have the conversation as we go forward. And I see that there's a few other questions coming in the chat there for the postcodes. I will just cover off, first of all, some of the ones that were asked for earlier. And to do that, I'm going to start with this one. This is from the Jester of Damocles. Great video, Martin. Appreciate all your efforts. Could you please do analysis on Wollongong, New South Wales, and Southport, Queensland? And funnily enough, of course, I always go to Wollongong as my first example. This is actually my template example, which shows you what we do. This is the output from our model. And you can see there, if you look carefully, you've got the household information. So 19,000 households there, plus or minus. What proportion are borrowing and renting? What proportion are owning outright? You've got the mortgage stress data. So in this postcode, mortgage stress is okay, but rental stress is pretty high. You can also see there the mix of houses versus units. So 35% of things are houses. 52% of properties are units. We've got the vacancy rates. We've got the gross and net investment yield. Net investment yield in this postcode is negative. People are losing money on investment from a cash flow perspective. We've got data on the taxable income as well. And that translates to disposable monthly income. And you can see there that 41% going on the mortgage, 2,467, and 33% going on the typical rent. From a scenario perspective, in the best case scenario, there is still some growth possible. But if we have those weaker scenarios, then maybe not. Now, the other thing we can do for those who asked ahead of time, we can look at price trends. Now, this is the median house trend for Wollongong. And you can see there that there were significant rises, particularly in the year 2022. Small rises since then. Earlier on, some rises and falls. And that overlays back in 2017, 789,000 compared with now 1.241. But look how it's pretty much gone almost nowhere since 2022. If I look at units in the same area, because there are more units, again, it's a similar story, although units are a little bit stronger. Now, that's partly because of the different mix of properties now being built. There are high-rise projects all over Wollongong, and those prices are actually for bigger apartments, more plush apartments, and that's put the median up. So some of that is distorted, but you can see there that, again, it was in January 2022, through that post-COVID period, that prices really escalated. And we'll see this in a lot of the information. It was actually all to do with the 2022 injection of cash and also low interest rates. Now, you also asked about Southport, and the Southport story, Queensland, of course, being one of those where we've got significant rises in value. Again, in the January 2022 sequence, 30% rise pretty much, and a bit of a fall then before that. But since then, every year, rises of at least, well, close to 10%, in some cases more. So we went from 349,000 back in 2017 to 840,000 in January 2026. Now, the other thing we can also then do, looking at my spreadsheet, is to dive into 4215. And if I do that, and let me just put that into my model, and then cut across, this is actually 4215. And you can see here in this particular example, we have 25,000 households. Mortgage stress is 82% in rental stress, so it's a lot of rental problems, a little bit of mortgage stress problems, but you can see here that more than half are actually renting in this particular postcode. And you can also see that 46% are units, so it's very much a question of building up rather than not. People ratio is low, so there'll be quite a few sole households there. Vacancy rate was quite high. Now, the vacancy rate related back to the census. Back in 2021, that was just around the COVID period, so that might be a bit off. But you can see here that the gross investment yield is 4.4. Net investment yield is minus, just a little, minus 0.2. Average taxable reported at 75 from the ATO and 64,000 from the household census. That translates to a gross monthly income of about $4,500, with 41% going on typical mortgage and 43% going on the typical rental. In terms of scenarios, yep, there is definitely a scenario where prices rise, but there is also a question now, if we get this interest rate increase and we get recessionary factors coming in, well, things could fall as well. So that's worth just bearing in mind in terms of what may happen next. Okay, let's go on and continue the journey of postcodes. A lot to get through, but the next one is coming from MT Curtin, who asked for Bondi Beach 2026. So let's first look at 2026 from a data perspective. Okay, 2026, Bondi Beach. So the first thing to notice is that we've got high rental cohorts, 56% are renting in this area. The rental stress is very high, mortgage stress not so much. We've got houses at 9%, but units, so it's mostly units in this area. We've got a people ratio that's relatively low, so that's sole occupiers as well as some perhaps couples. We've got high vacancy rates. That probably was to do with the COVID period. I think it's lower now. Gross investment yield is only 3.2, but the net investment yield again is negative, 1.2 down. And the taxable income on average, 170,000 from the ATO, but 150,000 from the census, gives a disposal monthly of around 10,000. But that gives you a 40.4% average mortgage of more than 4,000 a month, and a third, 33.6% at 3,300 for the typical rent. And at the moment, given what I see, I am not sure that we're going to see much in the way of growth in prices. True, whether you're looking at units, maybe down 5%, best case, maybe a bit more, or worst case, more. So interesting observation with regards to what may happen ahead. But with regard to what has happened, if we then look at the story with regards to the price trends, so this is the movements, and you can see there that we had a huge spike from January 2022, a drop in 2023, a big spike in 2024, not much in 2025, and a very small fall in 2026 so far. And that translates from just over a million 1,005 to 1,625,000 based on the latest data. Now that's for units, because units is the one that is predominating there. But I want to highlight that the momentum does seem to be easing, and I'm not sure we're going to see much growth ahead. So there you go. Let's look at another one. So this was from Woodvale, from DPM 5964, postcode 6026 Woodvale, please. Sure, we can do that. And so let's start this time with the price trend data for Woodvale. So this is, of course, in 6026, so Western Australia. And you can see there massive, massive rises. So huge rise in 2022, more than 20%. 24, 25, 26, rises in excess of 20%. Only 2023 was a slight adjustment. And that takes prices from 636,000 in January 2017 to 1.3 million in 2026. Huge rises. And we'll see this quite consistently in Western Australia. Western Australia is a real problem child in my mind because prices have got to the point where it really is not sustainable. And a few people were asking, is it likely that we're going to see falls ahead? So let's look at my data for 6026. Okay, there you go, 6026. And you can see there that we've got nearly 9,000 households. 48% are borrowing, so a lot of new purchases in the area, very little renting, but 40% do own outright. A lot of rental stress there as well. And you can see there that it's mostly houses. You can see also there that the people ratio is quite high, so that's families. Vacancy rate, quite low. Gross investment yield, 3.9. Net investment yield is just positive. And the average taxable came in from the ATO at 98,000. Household census at 111,000. The multi-flag has come up because that suggests that it's more than one times income. And of course, we are seeing this, as I quoted earlier on from CBA. Disposable monthly income is around 6,700, with 37% going on the typical mortgage and 32% going on the typical rent. Price trends, well, in the best case scenario, yeah, there is maybe a chance of momentum ahead. I'm not sure that we're going to see it, though, because it seems to be that Western Australia could be a turning point, but we'll see in the little time ahead. So that's the story on that one. Let's go on to the next one. So Helen asked for Brunswick in Melbourne, 3056. And we'll start with the pricing. So the trend here for Brunswick and its houses, you can see there, massive run up in January 2022, a fall in 2023, not much in 24 or 25. There was a rise in 2026, not quite 10%. And you can see there that the prices moved from 951,000 in 2017 to 1.285 million in 2026. And so you can compare the two. If you were thinking from an investment perspective, you would not be investing in Melbourne relative to what we saw in Perth, for example. Now, the interesting thing about this particular postcode, when I look at my data, and I'll just put that in, it's 3056. So let me just put that in. .3056. You can see here that there is a lot of rental going on. You can see that the rental stress and mortgage stress are both quite high. You can see that the mixture of houses and other types of property is, well, a little bit varied now. And that's because, of course, there are more building over retail accommodation and a few other things going on there too. You can see that the people ratio is on the lower side, so maybe some solos. And the vacancy rate was quite high. Students were away at the time. I think probably there are more students involved in this area now too. Gross investment yield is 3.3, but the net investment yield is strongly negative, minus 1.2%. The average taxable, 97,000 compared with 108,000 from the census. Multi-flag comes up, multiple incomes paying the mortgage. Typical disposable monthly income, more than 7,500, with 34.2% going on the mortgage and 29% going on the rent. And there isn't much in the way of property price growth that I'm seeing in this modelling based on the scenarios that I run at the moment. So that's the way I see that one. Again, scenarios, that's not a prediction, it's just a scenario as to what may happen. Okay, we've got another request, so let's go back to there. And very hard to know how to pronounce Roto. I'm not sure whether that's right. Anyway, Woodstock, Victoria, 3751, new home buyer area just coming on. Absolutely. And yeah, I don't have enough data in my surveys to report the full demographics. What I can tell you is that there is a little bit of population movement and that the median price is around there according to the data sets. But here is the price trend information. And it's quite interesting. If you look back in 2018 and 2020, very strong growth. But then not a lot happened in 21 and 2022, in 2023, but then there were significant falls in 2024 and 2025, and a further fall in 2026, which means in this particular postcode, prices were 634,000 back in 2017. In January 2026, 7,118, so hardly any move up. And if you look at the local area, this is beyond Donnybrook, out in that area, so between Donnybrook and Woodstock and Yan Yan, what you see is miles and miles of construction. And that is putting significant downward pressure. And one of the things I always want to highlight when I talk about this stuff is when you buy a new property, it's no longer new. Down the road in the next suburb, they're building new stuff. Those prices tend to actually be a little stronger. That means that by definition, just like driving a new car out of a forecourt from a garage, your property is worth less. We're seeing that in spades here and in Donnybrook and a few other areas too. So that's the story there. It's a really worrying story for those people buying into this area. So be cautious and careful about these, particularly homeland packages. A lot of them are overpriced, and a lot of the extras, which lifts the price, are not really worth what you're being asked to pay for them, in my view. Right, let's go on to the next one. So this is asking Zappa 8187. Thanks for all your coverage. I watch your videos daily now. Great. Good to know you have a regular follower. I appreciate that. And please like and subscribe too. And more broadly, folks, please like and subscribe to this channel. It makes a big difference. You asked for Maclean 2463. And yep, let's have a look. What happened in Maclean? So big rises in 2018 and 2022. Some rises in 24 and 26. Prices moved up from 289,000 back in 2017 to 671,000. This is the median house price in January 2026. And if we look at 2463 from my data set, let's put the number in. You can see here that we have quite a lot of people owning outright, quite a few people borrowing, some renting. The stress levels are quite high. Mostly houses. People ratio is a little bit higher than some, so that's probably families. The vacancy rate was quite high. That was from the census. Might be different now. Gross investment yields 3.3, net investment yields minus 1.4. Average taxable 73,000 compared with the census that said 58,000. Disposable monthly is around 4,200, with 43% going on the typical mortgage and 40% going on the typical rent. That explains the stress levels. And yeah, well, in one scenario or two, there could be a little bit of growth. But on the other hand, if things go a bit pear-shaped, maybe not. So that's the story there. Let's go on to the next one. So this is Kalamunda, Western Australia 6076 from Ryan. Doubled in the last 5 years and 23% in 25 alone. Not sure that's quite that my data, but we'll see. Kalamunda. Yes. Sorry. Let's just get to the right one. Kalamunda 6076. That's better, isn't it? Price rises. 614,000 in 2017 to 1.175 million in 2026. And yes, very strong rises. May not be 25%, but you can see there that significant rises in 2022, 24, 25, 26. In fact, no falls at all since 2020. But there were falls in 2018 and 2019. And if we look at 6076 from a modelling analysis perspective, you can see there that we've got about 8,500 households with 42% borrowing, so a lot of new mortgage holders may be off the plan. Mortgage stress, 41%, rental stress, 66%, 93% of houses, people ratio is high, so that's families. Gross investment yield is 4.1, net investment yield is minus 0.4. The average taxable is 109, giving a disposal monthly around 6,200 with 41% going on the mortgage and 28% going on the rent. And yeah, there is still growth ahead. Maybe not quite as strong in the best case scenario, but there is still growth. If things turn to pear shape, maybe not so much. So that's the story on that one. Okay, now the next one that we were asked to look at was Sunbury by Pando. Sunbury 3429, and we'll start with looking at the price trends. This is the house price trend. So there was significant growth in 2018. Never seen anything like it since. 2022, a bit of growth. 2026, a bit of growth. Falls in 2023, 2019, 2025. And we went from 419,000 then, back in 2017, to 578,000 in 2026. And if we look at the data for 3429, which I'll just put in, you can see there that we have 15,000 households, 49% of borrowing, a lot of mortgage there. A lot of mortgage stress there too, 69% in mortgage stress and rental stress. We've got mostly houses. We've got a vacancy rate that's relatively low, people ratio suggesting families, 3.2% gross investment yield, minus 1.1% net investment yield. Average taxable, 88,000, 100,000 household census, multi-flag comes up, 7,000 plus monthly income on average. That's the net disposal monthly income, so after taxes and what have you. 29% and 25% going on the rent and on the mortgage. And there, hard to see price growth in that scenario in the next 2 or 3 years based on what I'm seeing. Okay, let's look at the next one. Now, this is from Define Tree or something. 3690. I have your past one done a few years ago. This is a developing, much sought after area with people from New South Wales, Queensland, Melbourne, refugees moving here. Aussies, he says. Wodonga. Yeah. Well, let's look at Wodonga. It is quite interesting, this one here. So you can see there in 2020, there was a massive rise. In 2022, there was a significant rise. And in 2026, a very strong rise. And in fact, other than in 2021, it's up, up, and up, and up. So you can see there, we've gone from 307,000 to 669,000. So yes, still affordable, which is, I think, the key point. That's why people are moving down your way there, because it's affordable. And if we look at 3690 in my survey data, you can see there that we've got 14,000 households, 34% borrowing, 35% renting. Mortgage stress and rental stress are still up there, 67% and 81%. We've got 87% of houses. We've got 6.5% vacancy rate, 3.1% gross investment yield, net investment yield minus 1.5%. Average taxable around 75,000, and that gives a disposal monthly around 5,000, with 31% going on the mortgage and 26% going on the rent. A lot of interest in this area, I think. Let's look at the next one. From Carol, 4053, that's McDowall. And if we look at that particular postcode, 4053, you can see here again the same old Queensland story. Very strong growth in 2022, bit of a fall in 23, but then growth in 24, 25 and 26. And if we look at it, we went from 653,000 to 1.424 million over that 10-year period. And if we look at the stress data, 4053, you can see there that we have 19,000 households. We have 38% borrowing. We have mortgage stress at 41%, rental stress at 62%. We have 76% of houses. We have families probably in this area. Gross investment yield is 4.5. Net investment yield is positive. So this is actually an area where investors are still making a bit. Average taxable income, 99,000 or 111,000 from the census. That gives a disposal monthly around 7,000, with 34% going on the mortgage and 28.8% on typical rent. And you can see here, yep, there is still potential growth. Best case scenario with rises ahead. Base case, not so much. And worst case, well, a significant fall. Let's go to the next one. This is from John. Caloundra West. he said, Caloundra West. So there you go. And also a little mountain. Squeezing two there in, John. Okay, well, we'll see what we can do. Let's look at Caloundra West first. So if we do that, you can see there that there was a significant rise in January 2022, and then rises year after year after year other than 2023. And that takes the price for an average house from 460,000 in 2017 to 1,057,000 in 2026. And if I do the same for Little Mountain, both the same postcode, of course, similar story, strong rise in 2022, rises in 24, 25 and 26, going from 534,000 to 1.22 million in 2026. And then I look at my data on 4551, which is at a postcode level, of course. I can't do the granular analysis I do down at the postcode level, at a suburb level, because it's too granular and statistically wouldn't be relevant. 28,000 households, 34% borrowing, some mortgage stress, but rental stress is higher, 71% of houses. And you can see there that the gross investment yield is 4.4, net investment yield is just negative. Taxable income around 85 or 77,000 from the census, giving a disposable monthly of just over 5,000, with 44% going on the mortgage, 42% going on the rental. That's why there are some pressures there. And you can see there, yeah, there's still growth in the best case scenario, but not so much in the others. And let me go on to the next one. Andrew Joy has just dropped in. Hi, Andrew. Nice to see you again. Hope you're well. And thanks for dropping in. Next one, West Ryde, 2114. And glad to help. Let's look at some of the data. West Ryde, 2114. So, of course, West Ryde is some houses. Firstly, we'll look at that. So you can see there we've gone from 1.494 million in 2017 to 2.281 in 2026. But there's little growth in 25-26. Massive hike in 2022, 2024, fall in 23, fall in 2019. So a bit all over the place. If you look at units in the same area, it's a bit the same. Very strong growth in 2024. Not so much growth in 2022 there, and a fall in 2023, bit of a growth in 2026, going from 643,000 to 716,000. So not a huge amount of growth over that period. But if I compare it with my favourite North Ryde units, you can see there that their North Ryde units have gone from 905,000 back in 2017 to 777,000 in 2026. So they've actually had disastrous fall because, of course, they've been building so much new stuff. And so North Ryde 2113 is pretty interesting. And if I go back then to West Ryde 2114 and put that in my model, you can see there that it follows through with a lot of rentals in the area, a lot of rental stress in the area, 51% of units, 39% of houses. The rental investment profile is not great, 3.4% gross, but negative 0.9% net. Average taxable 97, household census 108. So there's a bit of a multi-flag come up. Just over $6,800 the disposal monthly, with 43.3% going on the mortgage and 31.2% going on typical rent. And you can see there, yeah, well, in the best case scenario, maybe a small rise, but if things go a bit pear-shaped, then maybe not. Right, we go on to the next one, and we'll have a look at another request. So here we have from No There, 6168 would be very interesting due to the US Navy coming into town. Greg asks, yep. Well, let's look at what's going on in that area. I've actually got that one there. And you can see, yeah, again, Western Australia, you can see the boom from 2021 onwards. Every year, close to 20%. Gone from 292,000 back in 2017 to 735,000 in 2026. Massive rise. And if you then look at the stress data for 6168, you can see there that we have 11,000 households. It's a third between borrowing, owning outright, and renting. Mortgage stress is not that high. Rental stress is very high, mostly houses. There was quite high vacancies earlier on, probably lower now because of the census. 4.2% gross net investment yield. Net investment yield is positive, just 0.1%. Taxables coming at 86,000 or 61,000 from the census, which giving a disposal monthly around 4,200, with 41% going on the mortgage and 35% going on the typical rent. And yep, prices are still potentially able to rise higher unless we get some of those more adverse scenarios coming through. If they did, prices may actually slide a little bit. Okay, next one. Let's look at Sunshine North. Stuart asked for that one. 3020. 3020 is an interesting one because, of course, it's Victoria, but it's maybe not typical. We'll see. So you can see here the movement. So 2018, 2022, 2026, drop in 2023, drop in 2025, gives you a move from 599,000 to 809,000. And in fact, the 10% rise in 2026 is a little bit unusual for some of the areas around Melbourne. So that's quite interesting. And if we look at 3022 from our analysis, 302R, I should say, when I say 22. Put the right one in, we'll get the right answer. So this is Sunshine, and you can see here that we've got 75% in rental stress, quite a lot of rental going on at the moment. Mortgage stress, not so bad. Mostly houses. Gross is 3.4, but net investment yields minus 1.3. And you can see there that the taxables in the sort of 73, 74s, giving just over $5,000 a month on average. 40% going on the mortgage, 33% going on the rent. And you can see there that, yeah, well, in best case scenario, maybe a little bit of growth over 3 years, but not a lot, in my view, based on what I'm seeing at the moment. Okay. Kay asked for Berala, postcode 2141. And 2141 shows an interesting story with, again, the January 2022 spike, 24 spike, 25 rise, 26 rise, a fall in 23, a fall in 2019, going from 915,000 to 1.598 million in 2026. And if I put that into my model, 2141, you can see there that we've got 11,000 households, some mortgage stress, a lot of rental stress, and quite a few people actually renting there at the moment. And we've got 44% houses, some units as well in the types of property. Gross investment yields 3.5, net investment yields positive 0.4. Average taxable 74,000 or 93,000 on the census, giving disposable monthly around 6,700, with 40% going on the mortgage and 34% going on the rent, and maybe a little bit of growth ahead depending on the scenario. Okay, Martin asked for Bundaberg, 4670, please. And as you know, Bundaberg appeared in my analysis earlier on. So here is the Bundaberg story, again, Queensland, through the moon, really. From 197,000 back in 2017 to 502,000 now. Ooh, that's a big one. January 2022, we had 35%. And then we had significant rises, around 15% in 23, 24, 25, and 26. And if we look at the 4670 data, two observations. First is quite a few people own outright, but a lot of people borrowing and renting. You can see a lot of rental stress there. You can see it's mostly houses. Gross investment yield is positive. Net investment yield, not quite. Average taxable is around 79, give or take. And the monthly disposal is just over 4,000, with 36 and 33% going on the typical mortgage or typical rent. And yeah, there are scenarios where prices can still rise. Actually, quite a lot if things go well, but there are also scenarios where things may go the other way. So it's worth keeping an eye on that. What's going to happen to the inflation story? What's going to happen to the unemployment story? Okay, let's go to the next one. David asks for Cairns, 4870 or 4868, please. Okay, well, let's do 4870. Here's the story here. So you can see the changes were up and down, up and down, up and down. Strongest was in January 2024 and January 2026. And we've moved from 422,000 back in 2017 to 613,000 in 2026. I also did the other one for you as well. Similar story, really. From 337,000 to 624,000. And in terms of my analysis, let's put that in. So I'm going to do 4870 simply because it's the North Cairns up around that area, but it gives you a bit of a flavour. A third borrowing, quite a few renting, some mortgage stress, more houses than units, but still some units too. Gross investment yields positive, net investment yields not. And you can see the taxable there is around 83,000, giving a disposable monthly of over 5,000, with 34% going on the mortgage and 28% going on the typical rent. Right, next one. So Paul asked to check Hamilton, Brisbane 4007. Let's look at the trends first. So you can see there that 4007 had strong growth in 22, 24, 25, 26, typical Queensland story. Compare that to previously where there were falls in 2018 and 2020. And it's gone from 493,000 to 909,000. And if I look at 4007 in my model, you can see there that we've got 7,000 households. A lot of renters, not that many borrowing, 26%. A lot of rental stress, 29% houses, 61% of units, and we've got gross investment yields at 4.6. Net investment yield is just negative. Strong income actually, 160,000 from the ATO and the census at 110. That gives, let's say, 7,000 average monthly. 38% or 30% going on the typical mortgage or rent payment. And yep, there is still more upside, although maybe not as strong ahead, depending on what happens with the broader economy. Okay, now Paul asked for Hamilton Hills 6163. It's taking me to areas I've not seen for a long time. Look, another Western Australian strong story. 513,000 compared with over a million, 1,059 million in 2026. And, well, it is the story of Western Australia, isn't it? Bubble, 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 bubble. And the question is, of course, how sustainable is that? Well, maybe less than perhaps people think now. We'll see. I still think there is a chance of a turn, but the question is when. What happens to the mining sector, of course, is critical here. And looking at the stress data, you can see there that in this particular area, you've got 23,000. There is a lot of mortgage and rental stress. That's because, of course, the prices have gone dramatically up. Income's strongish, but haven't really followed. Mostly houses. There is gross investment yield of 4.2. Again, a negative net investment yield. I'm seeing that in Perth and Western Australia quite broadly now. Average taxable 93 compared with 85,000 for the census. Gives you a disposable monthly 5,000, 6,000, something like that. 40.8% go on the mortgage and 32.7% go on the rent. And yep, there is still some upside, but not as strong maybe, but some downside scenarios too, based on what happens economically speaking. Okay, Leanne asks for postcode 4565 Tewantin, and Cooroibah 4567. Well, let's have a look. Tewantin first. Place I know very well, actually. Spent some lovely time there. So this is up in Queensland, of course, inland from the Sunshine Coast. Postcode 4565 has gone from 512,000 back in 2017 to 1.326 million. Now, growth in 2022, 24, 25 and 26 so far. And there was growth in 2021 as well and 2018. So very strong momentum. And the other one you asked for was Cooroibah 4565. Bit of a different story here. Very strong growth in 2022, but then not so much. So from 629,000 in 2017 to 1.569 million in 2026. And then if I look at the stress data, let me go back to 4565 and put that in. Okay, so 6,200 households, a third of borrowing, 23% of renting. Mortgage stress and rental stress are actually quite high here. 85% of houses. Gross investment yield is 4, net investment yield is minus 0.5. Taxable income around 80,000 or 67,000 from the census. That gives us a disposable monthly, well, knocking on $5,000, with 45.7% on the typical mortgage and 45.4% on the typical rent. And I see that quite often in these outer areas where prices are up, so people have got big mortgages, but incomes have not followed. So yeah, that's one to watch, I think. And then if I go back to your other one, you asked also for 4565. We can just briefly put that in. Oh, hang on, that is 4565. What was the other one? Hang on. Okay. Yeah, you see, I'm confusing myself now because they're both the same postcode. So there you go. That's the aggregate average. The price data I've got is at the suburb level. The stress data is actually at the overall postcode level because I can't do it at a more granular level. Right, next one. Fedor asks for 2233 Engadine. Know that very well. Used to drive up and down through that when I used to go from Thurrool up to the city. And we'll look at that one. Trend prices, 2233. Going from 885,000 to 1.534 million. Strong growth in 2022, fall in 23, rise in 24, fall in 25, rise in 26, up, down, up, down. And if we look at the data on 2233, you can see here we've got 10,000 households, half are borrowing, a lot of people with mortgages there, 75% of renters in rental stress, 81% of houses. We have gross investment yield is 3.4, net investment yield is minus 1.2. Taxable income, well, the census is 124. Excuse me. Individual ATO said 97,000, and that gives a disposable monthly around 7,000, with 43 going on the typical mortgage, just over $3,000, and 35% going on typical rent. Scenarios, well, yeah, there's still some growth possible in this particular area ahead on the best case scenario, not so much on the others. Okay, let's go on again. Nasdaq Trader asked for postcode 2259. So let's have a look at that one. 2259 is Wyong, north of Sydney, of course. And here we've got a move from 484,000 in January 2017 to January 2026, where it's 884,000. Big growth in 2022. And again, I want to emphasize this period of high government stimulus and lower interest rates really kicked prices higher. 23 was a fall, 24 was a rise, 25 was a fall, 26 was a rise. And if we then look at 2259 in my analysis, you can see here we've got 30% 39% borrowing, a lot of mortgage and rental stress, both above 70%. We've got mostly houses. We've got a gross investment yield of 3.4, but again, a net negative investment yield of minus 1.5. Average taxable, that's around 80,000, giving disposal monthly around 5,300, with 43% going on the mortgage and 38% going on the typical rent. Yeah, it's not great, and not a lot of upside from a momentum perspective in the time ahead, based on what I'm seeing. Right, let's go to the next one. Trevor asked for Coffs Harbour, 2450. If we look at Coffs Harbour, significant growth in 2022. Again, nothing in 2023, fall in 24, small rise in 25 and 26. We've gone from 400,000 back in 2017 to 830,000 in 2026. And if we look at 2450, oops, push the wrong button. 2450. You can see here we have 80% of renters in rental stress, 1/3 borrowing, pretty much, some renting as well, 71% of houses, 3.4% the gross investment yield. But again, net investment yield is negative. I'm seeing more and more of these negative net investment yields. Taxable incomes are at 80,000. Disposable are at 5,000, giving 42.1% of the mortgage and 37.3% on the rent. And yep, there's still price growth possible in the best case scenario, but not so much on the others. Right, we're coming towards the end of the ones that we asked for pre. But Semi asked for no less than 3. Greystanes, Concord, and South Granville. Well, let's go through those then. Greystanes. 2145, I should say. A rise from 851,000 to 1.5 million. Strong growth in 2022, 24, 26. This is for houses. Concord. Rise in 2022, rise in 2024. Not so much since then. A little rise. You've gone from 1.9 million to 3.29 million over that period. Again, most significant growth in 2022. And South Granville, a bit similar, strongest growth in 2022 from 834,000 to 1.416 million. And if I then do my little analysis based on 2142 first. So this is Granville. You can see there we've got 25% borrowing, a lot of rentals. 94% in rental stress, actually more units than houses these days, and gross investment yield is 3.5, net investment yield is minus 0.9. Average taxable is around 70 to 80,000, giving a disposal monthly around 6,000, with 40% going on the rent of mortgage and 33% going on the rent, and not much in the way of growth in terms of prices that I can see. And if we look at the Concord 2137, we'll put that one in now and do the same thing. 2137 Concord, 30% borrowing, 89% in rental stress, 43% with houses, 45% in units. More units, of course, going up all over the place. And you can see there 3.4% gross investment yield, minus 1% net investment yield. 120,000 is the typical income, giving a disposal monthly around 7,500 or 47.9% on the mortgage and 37.1% on the rent. And no, can't see much in the way of price growth ahead. And if I look at the other one you asked for, Greystanes 2145. And here we've got 34% borrowing, 41% renting, not a lot of mortgage stress, but quite a lot of rental stress, 50% houses. And we've got 3.4% gross investment yield, again, negative net investment yield. Multi-flag comes up because the taxable income's around 90,000, whereas the census at 108,000. It's supposed monthly around 7,000 plus, with 36.9% going on the mortgage and 29% going on the typical rent. And yeah, there is some growth potentially possible in the best case scenario ahead. Right, we're getting close to the end, and I can come back and look at the chat and see whether there are others that people would like. But I just got one more here, which is this one from Noah Scott, 6280. Vasse, I suspect, or is it Vasse? Or Vasse, I don't know how you pronounce that one. So we'll make it up as we go along, as normal. Western Australian trend, very strong. 2022, 24, 25, 26. Small rise in 23. From 450,000 to 1 million plus in 2026. And if I then look at 6280 in my model, you can see there that we've got 12,000 households, 37% of borrowing, a lot of new mortgage holders, I suspect, 50% in rental stress, 87% of houses. Gross investment yield is positive 3.9, net investment yield negative 0.8. Average taxable is about 90,000, household census a bit less. That's a disposable monthly around 5,000 a month, giving 42.1% and 35.3% on the mortgage and rent respectively. Yeah, there's still strong growth potentially in the best case scenario. Maybe not so much in the others, depending on what happens ahead. And then there was just one more question, which I got thrown beforehand, which I just wanted to briefly touch on. So this was from Platinum Calculator, saying, any reason why Perth growth was dipping in 25 and then staged huge recovery? Not seeing it in my data. So I wonder which area of Perth you're talking about there. But certainly I've seen very strong growth in Western Australia in pretty much every year since the COVID, and it's still continuing. Why? It's a combination of high migration, the fact that prices were relatively low relative to incomes previously, although that's not true now. We are seeing more people capping out, and we are seeing rises in stress. So I do expect to see more significant pressures ahead. So let's have a look and do a couple of the other ones. Jason asked for Greensborough, Victoria 3088. Now I can't put the price trends up because that model is too complex for me to run real time, and so I can't do it that, but I can look at the data. So let's put in 3088, cut across to the model, and I'll get that off screen so you can see it. So this is Greensborough and St Helena, 10,000 households, 44% borrowing, 70% in mortgage stress, 90% in rental stress. That's very high, of course. That feeds into the depression in terms of price movements. 84% houses, 5.2% vacancy rate, 2.9% gross investment yield, minus 1.9% as the net investment yield, another loss, of course. Average taxable, 96,000 versus 107,000. The multi-flag comes up. Multiple income is going to pay that mortgage. Disposing monthly around 7,500 with 34.3% going on the typical mortgage, $2,600, and 26.3% at 1,999 going on typical rent, and no growth in my model based on any of the scenarios that I'm seeing at the moment. Okay, now we had 2153 from Smooth right at the top of the show. Okay, Baulkham Hills. So this is the Baulkham Hills story. 22,000 households, 45% borrowing, 21% renting. Mortgage stress very high, rental stress not so much. We had 75% houses. We've got a vacancy rate that's about 5%. The gross investment yield is 3.3%, but the net investment yield on average is minus 1.4%. Average taxable, well over 100,000, giving a disposable monthly of around 7,500 with 43.8% going on the mortgage and 35.6% going on typical rent. And I will make the point that there is actually a quite interesting correlation I'm beginning to see, where you've got households with a little bit more income, but really leveraged up to get that property out in those higher, more expensive areas. So I'm seeing quite a lot of that. All right, let's have a look, see whether there are any other requests that I need to cover off as I go back up. And, it's quite complicated now because everybody's got a number in their at monocle on YouTube. YouTube changed it, right? And the truth is that it's quite difficult to pick the postcodes now from the numbers. Don't see any more at the moment. Just running down the list now. Yeah, Thank you very much for the reminder. Please like this show. If you find this useful, please like and share. I really want to underscore that this is so important to getting this message out. I want more people to understand what's really going on the ground and how different locations are. Because, yeah, every scenario is quite different. Infinity Island asks, why is the scenario so pessimistic? And I've made the point. It depends on your scenarios, right? I could make a really positive scenario where we have low inflation, massive growth, and I could put the high inflation scenario the price growth momentum up much higher. I chose not to do that. If you want to give me a particular scenario for next month, and this is an invitation more generally, I can plug in 3 scenarios into my model. If you would like me to look at different scenarios next month, put them in the comments and I'll consider them. The beauty of the model is I can do multiple scenarios, but they just take a bit of time to run because there's about 20 terabytes of data that it has to trawl through to be able to produce all of this information. And that's one of the reasons why I can't do these price dynamics real time. Too much data in the system. Takes too long. Okay, found one. Glen Alpine in Campbelltown, 2560. 2560 I can do. It's, of course, quite a big area, so it includes Campbelltown as well as Glen Alpine. So Campbelltown might swamp Glen Alpine. 30,000 households in the area, 39% borrowing, 36% of renting, a lot of mortgage stress, quite a lot of rental stress, 78% of houses, gross investment yields, 3.3, but net investment, again, is negative, minus 1.2. I'm seeing more of this, more net investment yields. Taxable income, 78 to 80,000, giving a disposable monthly around 5,800, with 41% going on the mortgage and 32% going on the typical, 41% going on the mortgage and 32.6% going on typical rent, and can't see much in the way of positive scenarios. Unfortunately, in this particular postcode, it is very much a problem. And another one here, 3033. Do that one. This could well be the last one. East Keilor, 5,800 households, 40% in mortgage stress, 71% in rental stress. And you can see there that it's mostly houses. We've got 3.4% gross investment yield, again, a negative in net investment yield. Average taxable, it's around 100,000, giving a disposable monthly around 6,600, 39.2 and 30.5% respectively on the mortgage and rental payment. And yeah, it's the same old story. Slightly more income, slightly more leveraged. It is very much the story. Okay, Andrew Joyce just snuck one in. 6027. Nice one. 6027 is Curtin and in the Curtin area. Hopefully that's the right one. 6027, yeah, got it right. Okay. Running out of smoke, folks. I'm going to have to stop soon. Okay, here we have 31% own outright, 46% borrowing, and 21% renting. 16,000 households there, 40% in mortgage stress, 9% in rental stress, 85% of houses. People ratio is high, it's families. 4.2% gross investment yield, but again, it's slightly underwater from net investment yield perspective. So property investors feeling the pressure. Average taxable, 96,000 versus 104,000. The multi flags up. Multiple incomes going on that mortgage, giving a disposable monthly around 6,500 with 37.1 going on the mortgage, 2,400 and 29.3, 1,894 going on typical rent. And yep, still price growth possible in the best case scenario they ran. The worst case scenario, not so much. And I will highlight again, my scenarios are just indicative. It is very significant to see what's going on. Yeah, Curtin, Andrew. Curtin is the district that it's in, so that's the next level up, effectively. So that's just the way that it works. Oh, NASDAQ trader, lucky last, 4680. Whoa, you're pushing your luck, mate. But why not? Okay, 4680. Oh, Tannum Sands. Is it? Could well be. I can't tell. Anyway, I've put the data up. The reason is that there's such a long list. But there you go. 4680. And you can see there that we have 4,500 households. Some are renting, quite a few. Some with mortgages as well, of course. But the mortgage stress is not that high. Rental stress quite high, about half. 83% of houses. 11% vacant, so maybe Airbnb, maybe some holiday homes and things there as well. Gross investment yield 4.1, net investment yield minus 0.6, and taxable income, it's around the 71,000 mark, maybe slightly lower from the census. Census is older, of course. The ATO is from 22-23, so that's a bit more realistic, perhaps. Disposable monthly income 4,300, giving 35.6% on the rent, on the mortgage, and 28.67% on the rent. And yep, still price momentum in the best case scenario. Right, I think we're done on the scenarios. And firstly, Jason, I really appreciate your support as always. Thank you so much for the super chat. Thank you so much. It really makes a great difference and helps to keep us afloat. So thank you for that. And let me just go back to the sort of the final thoughts I wanted to leave you with now as we come to the end of the show. When you look at this information, three things stand out. It is very different in different locations. Secondly, the true impact on households is not being fully understood by many people. And there are a lot of people in difficulty. Remember, I'm measuring it in the early stages of difficulty. When people have financial pressures, the first thing to do is to get to grips with your finances and understand what money is coming in, what money is going out. Draw up a spreadsheet, keep a record, use an app, understand where the money is going. The second thing is to prioritize, and people don't do that very well at the moment. Only half of people in my surveys have any sort of cash flow sense. So a lot of people just spend and hope it's going to be fine. The third thing is people reach for more debt, and we're seeing significant rises in debt, particularly among those people with high levels of stress. Trouble with more debt, it just makes the problem worse, particularly if it's high interest debt. Credit cards, personal loans, buy now, pay later, or where, of course, you get hit with fees if you don't pay it off, or indeed even payday loans at the extreme. So, got to get to grips with your finances. If you have financial pressures, you've got a mortgage, go talk to your bank. They have a duty to help. They have an obligation under the hardship scheme. But quite often what they are doing is protecting their own position rather than necessarily your position. They'll extend and pretend. They'll extend the mortgage. They'll go interest only. They want to take you off the troublesome list. Doesn't necessarily solve the problem unless you change your behavior. So there's a behavioral change question here. More and more I seem to get to the point where people need to understand more about their finances. Prioritize. Look at some of those subscription services. Do you need them all? Do you need that really expensive phone plan? How many streaming services do you really need? Those sorts of things. And it's amazing the difference can be made. In fact, Edward and I were chatting because we've both reverted now to trimming our own hair rather than actually going to the barbers because it's so expensive. Stupid example, but Edwin reckon he saved $1,000 last year because of it. So I don't know. Anyway, if you have difficulty and you need help, be careful where you reach for help for. The National Debt Helpline is the one that I absolutely recommend. National Debt Helpline, 1-800-007-007 is the government-backed and funded National Debt Counselling Service. They're very busy. They reported the other day that they had huge increases in the number of inquiries. But they also make the point that those people who do actually get counselling can avoid legal action 74% of the time. 69% have more positive angles about their future. 66% resolve their financial difficulties. 63% improve their mental well-being. 53% avoid bankruptcy, and 45% improve their physical health. There is a real consequence of getting your finances under control, not just in terms of dealing with the debt itself, but physical health, relationships, all of those things, mental well-being. This is critical. So it is very, very important to do. I also make the point, if you need a tool, the Statement of Financial Position that the AFCA website offers is great. It gives you all the information in the right categories that you need to plug in, and you can then produce a statement that you can take to your lender or your financial counsellor or use for your own purposes. I recommend it. It is a very powerful tool, and you need to do some homework. point is, you can't rely on the government or the RBA or anybody else to sort of solve this financial pressure that people are in. This is going to stay with us. So it's down to managing your finances smarter. And I had to laugh. Happy Right Agent said, great suggestions. Thank you very much. NASDAQ Trader said, yeah, I've been trimming my own hair for over 20 years. Number 4 cut, 25 every 3 months. Lol. Very good. It is. I'm just, yeah. I think there's a general consensus, particularly from those who are follically challenged these days, that maybe hair trimming is not such a bad job. There you go. Tip of the week. Trim your own hair. Anyway, I think we've come to the end of the show. Just to say that I've really appreciated all the comments, suggestions as we've gone through, and thank you very much for those who put the questions in early. If you didn't get your postcode answered, there are a couple of ways that you can get the information. You can subscribe to my Patreon service, and there are various levels. Really appreciate those who support us at the various levels, and if you'd like to support me, feel free to sign up at the various levels. Get access to some additional stuff and access to everything that I do. But at the $50 plus GST month level, you can actually get the data set that I've shown today, particularly the stress data set, not the price trend data set. That's too big and complicated to set up. But the postcode level analysis I did, that's available. I'll be sending this out to all of those on the Patreon mailing list in the next few days, and then I'll be updating at the end of the month. Also, go to walktheworld.com.au if you want to find out more about what we do, and my blog. There is the blog there, the contact. You can get a message to me directly. I had a few issues with the blog a little while ago, but I think we've fixed them all now, so hopefully it's all running well. digitalfinancialytics.com/blog, and the contact button is there as well. And by the way, if you'd like to support me via PayPal, you can do that too. I do take PayPal as well. That's the link there. So we're done. Thank you very much for spending some time with me this evening. And Jason says, thanks very much. Thank you, Jason, again, for your super chat. Really appreciate it. And MCM, yeah, we'll see you on the next round. And just to say that next week, it'll be, I think Ruby Bar Week, I think, is on next week. And we're going to talk specifically about some of those mega political issues that are bubbling on, and also some of the particular campaigns that we think will be important this year, particularly relating to the police state, which is unfortunately lurking. So that should be a really interesting show, and I'll look forward to seeing you on that recorded show. We put out shows, of course, every day, and we make a live show every Tuesday, so look forward to that. And thank you for spending some time with us this evening. The dogs are sort of here. So the dog is, we've got one of the bit dogs. Maybe I'll zoom out just slightly so you can see a bit more. Luna's in a basket. Meteor's sort of sprawled out on the floor. She's given me a hint a couple of times that it's really time for lunch now. So that'll be my next task with the dogs. Anyway, thank you for spending time with us this evening. Hope you had a good evening and a good week. And I'll look forward to seeing you next time. This is Martin North from Digital Finance Analytics signing off. Take care.